I wouldn't go quite as far as Larry says in suggesting we should not be worried, because Arturo Estrella also suggested that if this trade war were to spin out of control, that could flatten that 10-year to 3-month curve and lead us toward recession. Now, he also said that when you're looking at the yield curve, the average lead time, and this has been true since 1968, is anywhere from 9 to 15 months, with the average lead time from the time the curve flattens to inverts is a year. So you do have some lead time if indeed we were to see this to happen. Right now, it's not happening in that particular curve. The 10 to 2-year spread is much, much flatter for a variety of other reasons.
Can I explain, just for the novice viewer? If you're going to lend money for 30 years, in theory, you're going to charge somebody a much higher interest rate because there's so much more uncertainty over 30 years than there is 3 months.
When it comes to inflation.
When it comes to inflation, all kinds of things, right? And then if suddenly long-term interest rates are much lower than short-term interest rates, why would you want to lend money at such a cheaper rate? And it's because you're worried that there's going to be lack of demand in the economy, perhaps a recession, et cetera, right? That's why we focus so much on the yield curve.
And typically it's because the Federal Reserve's raising short-term interest rates to cool down inflation, cool down the economy. The long end of the bond market sniffs out recession, and rates fall at the long end. So that's why, if the yield curve inverts, it's a recession indicator that has been extraordinarily reliable since 1968.
We've had two of our guests today, Ron, John Gray from Blackstone, David Rubenstein from Carlyle, who have decent insight because they have so many operating companies that they own, essentially, in their private equity in terms of the U.S. economy. They both were very positive on the strength of the economy. Do you agree?
Right now, yes. I mean, absolutely. The economy is firing virtually on all cylinders except on trade, and we can talk about that in a second. But we have more open jobs than we have unemployed individuals in the United States. So I would argue that we're pretty late in the cycle. If the Fed were to tighten too much, and we're not getting clear signals about that right now, you could see in a year a recession as a consequence of the Fed being overzealous on the inflation front, or more worryingly, the fact that this trade war could ultimately spin out of control and cause a global recession that doesn't necessarily start here, but it might end up here.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.